Wall Street cash warning. Every headline across global financial media seems to be shouting the exact same message right now: a massive market crash is inevitable. When the head of America's largest commercial bank publicly states he wouldn't buy stocks or long-term government bonds at current valuations, the financial community naturally takes notice. At the same time, legendary holding companies are sitting on historic cash piles reaching hundreds of billions of dollars, having been net sellers of equities for over 3 consecutive years. Across the United States, Europe, the UK, and Asia, retail investors are caught in a classic psychological trap. On one side, financial media tells you that an economic collapse is right around the corner. On the other, tech indexes continue pushing near all-time highs, driven by massive corporate capital expenditures in artificial intelligence, automation, and industrial infrastructure. So what is actually happening beneath the surface? Are we living through a historic, central bank-fueled market bubble set to pop in late 2026? Or is this simply another wave of noise designed to keep retail capital frozen on the sidelines while institutional money executes long-term asset allocation? Today, we are examining the data, filtering out the media hype, and quantifying actual risks across global markets. Crucially, we will break down an actionable operational framework, showing you exactly where capital should move across core index ETFs like VOO, FCHD, and VXUS, and how to position your cash reserves right now. 2. Examining the macro risks, debt, inflation, and valuations. To evaluate the validity of current crash warnings, we must first break down the primary structural risks confronting the global economy. First, sovereign debt has reached levels unprecedented in peacetime. Sovereign nations across the developed world are spending significantly more than they generate in revenue, refinancing massive debt stacks at sustained, elevated interest rates. This structural deficit forces long-term bond yields higher, raising the baseline cost of capital for corporations, home buyers, and small businesses alike. When risk-free yields remain attractive, high-priced equities face intense valuation friction. Second, geopolitical friction and trade reshoring continue to inject cost pressure back into global supply chains. When tariffs or trade barriers are introduced, corporations rarely absorb those expenses, they pass them directly down to end consumers. This dynamic creates persistent, sticky inflation that prevents central banks from rapidly slashing interest rates to rescue asset prices. Third, equity valuations, particularly within the S&P 500, are historically rich. By metrics like the Shiller-Cape ratio, current market multiples leave virtually no margin of safety for operational hiccups, earnings misses, or supply chain disruptions. When stocks are priced for perfection, even routine quarter-over-quarter earnings stumbles can trigger sharp 10% to 15% valuation drawdowns. 3. The truth filter, distinguishing panic from fundamentals. Now let's apply a strict truth filter to these warnings. It is essential to separate sensational retail commentary from empirical financial mechanics. First, a record cash pile does not equal an immediate market collapse. Institutional capital accumulates cash not necessarily because a crash is occurring tomorrow, but because high-conviction, large-scale acquisition targets at steep discounts are currently scarce. Holding short-term risk-free yield while awaiting structural dislocations is disciplined portfolio management, not an apocalyptic prediction. Second, media headlines profit from fear, but wealth is built on corporate cash flow. Sensationalized titles generate clicks, but over decades, stock prices follow underlying corporate earnings per share. Despite macro headwinds, Tier 1 global technology, medical, and industrial enterprises continue to generate record free cash flow, operating with fortress balance sheets that bear little resemblance to the over-leveraged entities of 2008. Third, market pullbacks are healthy, expected features of long-term investing. A 10% market correction occurs, on average, once every 12 to 18 months. A 20% bear market occurs roughly once every 3.5 to 5 years. Experiencing a market pullback is not evidence of a broken systemic model. It is the price of admission for equities outperforming risk-free cash over multi-decade horizons. 4. Regional analysis, US, Europe, UK, and Japan. The macroeconomic picture is not uniform across the globe. Diversifying your understanding across regional markets reveals distinct opportunities and risks. Region primary structural drivers. Valuation and market character. United States. High earnings growth. Heavy AI capex, massive consumer base. High PE multiples, vulnerable to short-term valuation cuts. Europe and UK. Value heavy, financials, energy, strict regulatory environment. Modest multiples, lower organic tech growth, solid dividend yield. Japan. Tokyo Stock Exchange reforms, inflation return, governance shift favoring shareholder returns. Unwinding carry trade dynamics, attractive long-term corporate balance sheets. United States. The U.S. remains the world's primary engine for corporate innovation and liquid capital. However, because U.S. indexes are heavily weighted toward top mega-cap tech stocks, any temporary rotation out of high multiple growth equities causes outsized volatility in the benchmark index. Europe and the UK. European and British markets trade at significantly lower earnings multiples compared to their U.S. peers. While organic mega-cap tech exposure is limited, these markets offer established financial, industrial, and healthcare institutions yielding steady dividends. Passive boosts indexation, such as tracking the S&P 500 or MSCI World Value Cost ETFs, remains the preferred vehicle for European retail wealth accumulation. Japan. Japan's structural picture has undergone a generational shift. Governance reforms mandated by the Tokyo Stock Exchange have pushed Japanese corporations to deploy excess cash reserves, buy back undervalued shares, and focus on return on equity. While short-term yen currency fluctuations can create market waves, Japan's underlying corporate health remains a key area for international diversification. 5. The 3 non-negotiable prerequisite milestones. Before deploying capital into volatile global equities, especially during periods of heightened market anxiety, you must fulfill 3 foundational financial prerequisites. Ignoring these rules turns investing into pure speculation. Establish a stable, recurring cash flow. Investing in equities is not a one-time transaction, it is a long-term allocation process. You must possess a reliable income source, whether through employment or an established business, that allows you to dollar cost average consistently through both market booms and drawdowns. Build a 3 to 6 month emergency liquid fund. Never invest capital that you might require for short-term living expenses. If life throws an unexpected curveball, a job loss, medical event, or business slowdown, a dedicated liquid cash buffer prevents you from being forced to liquidate your stock investments at a loss during a market bottom. Eliminate high-interest consumer debt. Carrying high-interest debt while purchasing volatile stock assets is a mathematical error. Guaranteed double-digit interest charges on consumer credit will erode long-term variable market returns. Pay off consumer liabilities before deploying discretionary wealth into equities. 6. Portfolio execution framework and operational capital allocation. So where does your capital actually go right now? Rather than sitting on frozen cash or gambling on speculative individual stocks, here's the operational execution framework for late 2026. Buy/accumulate. Core anchors. U.S. broad market, VOO or VTI, allocate 50% to 60% of new monthly investment inflows into ultra-low-cost S&P 500 or total market funds. This captures long-term corporate productivity and AI tailwinds automatically. International developed markets, VXUS, allocate 15% to 20% of capital into international ETFs to gain exposure to cheap European dividend compounders and restructured Japanese balance sheets. Hold/rebalance, satellite income and growth. High-quality dividend and value, FCHD, hold core dividend holdings. In high-CAPE environments, dividend reinvestment acts as a stabilizing return engine during flat or sideways markets. Concentrated big tech, QQM, hold existing positions, but pause aggressive lump sum buys. Let automated dollar cost averaging handle entry points during volatility. Sell/rotate out, risk reduction. Sell speculative single stock growth, exit unprofitable, high beta single stocks trading at extreme multiples without positive free cash flow. Sell high fee active funds, liquidate legacy mutual funds with high expense ratios that fail to beat their benchmark index. Turn to cash/short-term treasuries, strategic reserve. Maintain 5% to 10% of total portfolio in high-yield cash equivalents or short-term treasury ETFs, BIL or money market funds. This isn't panic hoarding, it is operational dry powder reserved specifically to execute limit buys when 10% plus market pullbacks occur. 7. Key takeaways and conclusion. Let's summarize the core conclusions of this analysis. Wall Street cash is a tool, not an alarm. Institutional cash accumulation reflects a disciplined search for value, not a guaranteed date for market crash. Filter media fear. High-CAPE valuations mean lower forward returns over a decade, but do not predict short-term market collapse. Index over speculation. Passive. Broad market indexation eliminates single stock risk while capturing long-term global corporate growth. Prioritize the fundamentals. Secure stable income, clear high-interest consumer debt, and establish a 3 to 6 month cash reserve before investing. Execute strategic capital moves. Systematically buy broad market anchors, VOOVXUS. Hold resilient income streams, FCHD. Sell high multiple speculative hype, and maintain a 5 to 10% strategic cash buffer for market pullbacks. Why does this matter right now? Because the biggest threat to your multi-decade wealth isn't a 15% market correction, it is panic selling at the bottom or letting fear lock your capital in cash while inflation erodes your purchasing power. Master your foundation, automate your strategy, and let global corporate compounding work for you. Before we sign off, community posts poll question: how are you handling your investment portfolio right now? Like, subscribe. Broker offers are in the description. Disclaimer: I am not a financial advisor. This video is for educational and entertainment purposes only. Always perform your own due diligence before investing. Farewell.
This is the stock market performance playlist, the sound of victory. Peace. Yeah.